We're at REIT Week 2010 in Chicago, and I'm joined by Steve Buller, fund manager with Fidelity. Steve, looking at the European property markets, how have the recent problems in Europe affected the companies there?
They've impacted most property securities worldwide, and I would argue, one, rightfully so, in effect the ones in Europe, as we could see a potential slowdown in economic activity, but two, probably wrongly, other places in the world where I think they're just going down in sympathy with those European property stocks and the market itself.
At present, how does the U.S. compare with the rest of the world in terms of commercial property investment?
I would rank it probably there in the top third in terms of investment opportunities. First of all, you're probably going to be coming with the cyclical recovery compared to other markets which did not get hit so hard. And second, we see that you're going to have external growth opportunities, primarily through acquisitions. This market in the United Kingdom probably offers the most opportunities to have external growth.
And looking at Asia, what are some of the problems that are existing in that market?
I would separate that into two parts, first of all. First, it's the commercial side, where we don't see that many problems, whether it's on the office, retail, or lodging side. But second, on the residential side, many of the Asian securities have a component of residential for sale. Here we see policy, government policy, dictating the stock movements more than anything, whether it's China trying to cool down its overheated property market, or whether Australia, in a similar vein, trying to more recently restart its residential market.
And as an investor looking at global real estate opportunities, what's the biggest challenge you face in evaluating, domestic U.S. companies when you're looking at companies abroad?
The biggest difference is, one, you have language, you have customs, you have cultural difference in meeting with the companies. In addition, there's some minor accounting differences you always have to take into account. But I would argue there's also some things you learn over time. For example, lease structure in Japan is typically 2 or 3 years, but the majority of those companies renew, and they renew at sometimes more favorable than actually market prices. So you got to know that it's more of a long-term lease than is embedded what you think could be a short-term lease.
Mm-hmm. And the last question, now that we're looking out at the second half of the year, what's your overall impression of the global real estate market?
We look upon it favorably after the recent price correction. First of all, you still have, even though absent the last couple of weeks, financial and credit markets continue to get ever so better at the margin, which is good for property securities. And second, we are in the camp that you're going to see, albeit slow, cyclical recovery in many of the markets, so that should lead to better fundamental growth.
Great. Steve, thank you very much.
You're welcome.
For more news and analysis from REIT Week 2010, check out REIT.com.